Welcome to our explainer. Today, we're unpacking the double-edged sword of financial technology, and specifically, how fintech is rapidly transforming India's economy. On one hand, it's offering this incredible, totally unprecedented access to capital. But on the other hand, it's presenting brand new risks that regulators and honestly, consumers like us are just scrambling to keep up with.
So that brings us to the core question of this whole explainer. Is fintech genuinely democratizing finance, or is it just setting a modern debt trap? We're going to explore if these digital tools are actually bridging massive wealth gaps for businesses, or if they're simply creating hidden pitfalls for everyday consumers.
Here's our roadmap for today. First, India's digital finance revolution. Second, closing the MSME gap. Third, the BNPL debt trap. Fourth, navigating the crypto maze. And finally, the regulatory pushback. Let's dive right in.
Section 1. India's digital finance revolution. From traditional banks to instant digital credit. You know, for decades, traditional banking has been notoriously slow. Think mountains of physical paperwork and a total, absolute reliance on collateral. Basically, if you didn't own assets, you were completely out of luck. Well, enter the fintech era. It totally bypasses all that red tape. By using alternative data, things like GST and digital transaction histories, they can literally approve credit in seconds. It completely changes the game of who actually gets access to money. Section 2. Closing the MSME gap, fueling the backbone of the economy. 20 to 25 lakh crore rupees. Just let that massive number sink in for a second. That is the staggering credit gap left behind by traditional banks. Because older systems rely so heavily on collateral, millions of perfectly viable businesses have just been left out in the cold. It's a massive missing piece of the economic puzzle that micro, small, and medium enterprises desperately need to grow. And fintech? Well, it's quickly become their much-needed lifeline. I mean, think about the scale here. There are 6.3 crore MSMEs in India, making up 30% of the national GDP and employing nearly 11 crore people. They are, without a doubt, the absolute backbone of the economy. So, to bridge the gap where traditional banks were falling short, fintech lending companies operating completely outside those traditional banking structures stepped up. They dispersed over $12 billion in small-ticket loans in just the 2025 financial year alone. They are actively fueling the economy exactly where it's needed most. Okay, moving on to Section 3, the BNPL debt trap, the psychology of the checkout cart. Now, this massive shift to digital credit perfectly mirrors our adoption of smartphones and the internet. As connectivity climbs, credit literally becomes just a tap away. And this wild ease of access is driving the buy now, pay later market toward an absolutely massive $30 billion projection by 2025. Mostly thanks to seamless integration right there at your online checkout cart. So, who's actually driving this explosive $30 billion trend? Well, around 60% of the market is powered by Gen Z and millennials. A lot of young consumers simply don't have traditional credit cards, or they just actively avoid them. But they absolutely love the flexible, split payment models that BNPL offers directly on their smartphones. It feels incredibly accessible, right? Very modern. But of course, there's a catch. Behavioral economics actually warns us about this psychological trap. The postponement of payment dulls the immediate feeling of liquidation. Basically, in plain English, when it doesn't feel like real money leaving your bank account right this second, you are, statistically, way more likely to impulse buy. You know, that 2 a.m. espresso machine you definitely don't need, and frankly, might not even be able to afford. And that brings us to models like Pay in 4, which literally breaks a purchase down into 4 smaller installments. Sounds super manageable, right? But this model actually deliberately obscures the true cost of the items. For inexperienced borrowers, these seemingly affordable little micropayments quickly snowball. Before they even realize what's happening, they're juggling multiple loans across different apps, getting hit with harsh late fees, and just falling straight into a very modern debt trap.
Section 4. Navigating the crypto maze, the highly taxed gray area.
Now, while BNPL targets your everyday consumer spending, cryptocurrency targets your digital investing, operating in a totally different, highly volatile space. To navigate this maze, let's just look at the facts. Yes, it's completely legal to buy and hold crypto in India, but it is explicitly not legal tender, meaning you can't go buy your groceries with Bitcoin. Instead, the government treats it as a heavily taxed asset. We're talking a flat 30% tax on capital gains, plus a 1% tax deducted at source on transactions over 50,000 rupees. Plus, the rules are just constantly changing. You get regulatory whiplash. Back in 2018, the RBI outright banned banks from providing crypto services. Then, fast forward to 2020, the Supreme Court dramatically reversed that ban. By 2021, a new crypto bill was proposed that actually aimed to ban private coins entirely while still supporting the underlying blockchain tech. It's this fascinating regulatory pendulum that continually keeps investors on their toes.
Honestly, that hesitation from the government makes total sense when you look at the inherent risks here. Without central regulation, these digital assets bring some really serious real-world vulnerabilities. We are talking about extreme value crashes where life savings can literally be wiped out overnight. Add in sophisticated hackers targeting exchanges and pseudo-anonymous transactions that make digital currencies a haven for money laundering. It's basically a perfect storm of digital risks.
Which leads us to our final section, Section 5, the regulatory pushback, building the guardrails.
Okay, so to prevent systemic collapses and actually protect consumers, authorities are fighting back with some fairly strict rules. First up, the RBI enforced comprehensive digital lending guidelines. This basically forces lenders to be completely transparent about any hidden charges and requires explicit customer consent for data usage. Second, crypto has been brought under the Prevention of Money Laundering Act to closely track illicit transactions. And third, 49 crypto exchanges, both domestic and offshore, are now mandatorily registered with FIUIND, India's Financial Intelligence Unit. This forces them to operate with the exact same anti-money laundering obligations as traditional banks.
So, to wrap this explainer up, while fintech undoubtedly offers incredible, unprecedented access to capital, powering those MSMEs and enabling instant digital transactions, it absolutely demands caution. As digital finance rapidly evolves, you really have to ask yourself, are you managing your money, or is the technology managing you? Because in this new digital economy, your personal financial literacy is your absolute greatest defense.